Oh, hi, Kaylee.
Hello. How's it
All
going?
right, you're all in on chapter 6, huh?
Yes.
Now we get into some good stuff, huh? You haven't taken the test yet, have you?
No, I haven't. I did the practice test last eve or yesterday evening, and then I'm gonna do it again today. And I'm hoping probably tomorrow in the morning I'll take it.
Yeah, you should do very well.
Thank
Very well.
you.
All right, let's see here. Hold on one second. I'm going to share a screen. Okay, y'all ready for chapter 6?
Yes.
Now we get a little more real life type things. Reporting, interpreting sales revenue, receivables, and cash. What's going to happen now is each chapter is going to concentrate on a particular part of the balance sheet and an income statement.
Okay.
Next chapter is on inventory and cost of goods sold. Next one, fixed assets, depreciation. So let's see what we have here. Oh, this thing has a funny touch. Okay. Okay, we should know now that revenues are recognized when they're recorded.
Yes.
Okay, we've gotten beyond that. But your sales can be impacted by certain things. Credit card sales have an impact. Something called sales discounts. And these are not the discounts you see when you walk into a store and you see something is 10% cheaper. Sales returns and allowances. You see these three things here, Kaylee? Credit card fees, sales discount, sales returns and allowances.
Mhm.
Say hello to 3 new contra accounts. These are contra sales accounts because
Okay.
you never debit sales. You never debit sales, never debit sales. Okay. But we need to reduce our gross sales once in a
Mhm.
while. Gross sales. We've been talking about net sales, right? You've heard net sales. We're
Right.
going to start with a higher number. We're going to start with what's called gross sales. And then by subtracting these contra accounts out, we're going to come down to net sales. Then we have something called bad debts expense, which is a tricky part of this chapter. But let's see where they take us. Credit card sales. Companies, accept credit cards for a lot of obvious reasons to increase
Right.
sales. You get paid right away. There's no bad checks. Any fraud on the part of the guy passing the credit card is not going to impact the business, and
Right.
you get paid quicker. Okay. But
Mhm.
companies have to pay for that service.
Mhm.
Like when I buy my jug of soda every morning for $2 at 7-Eleven, I use a credit card, which means that 7-Eleven is not going to get $2 from Visa. They're only going to get $1.90. And that difference is called a credit card fee and is thus a contra sales account. When the credit card sales are made, the company has to pay a fee. So that is a contra sales account.
Mhm.
Sales discounts. When customers purchase on an open account, they may be offered what's called a sales discount to encourage early payment. And you need to be able to read this translated correctly. This means 210 net 30. You read this as 210 net 30. 2% 10 net 30 days. 2% 10. It means, Kaylee, if you pay your bill within 10 days, we will give you a 2% discount.
Right.
If you pay in 30 days, you pay the net, the entire amount. Okay. And if someone gives you a 2% discount for just 10 days,
Mhm.
you would really want to grab that because that's a fantastic deal. 210 net 30. It could be 310 net 45. It could be, 220 end of month or something.
Mhm.
So understand the 210 net 30. And let me This thing is bothering me here. This thing has a delay today. And they're just describing it, the discount percentage, number of days. Otherwise, the full amount is due. When discount terms of 2/10/30, a customer saves $2 on a $100 purchase by paying on the 10th day instead of the 30th day. But take a look at how dramatic that is. Do you
Mhm.
think you could go to a bank today with $100 and then 10 days later they'll hand you $102?
No.
The answer is absolutely zero. In fact, under today's interest rates, it would take you 2 years to
Right.
come up with $102. So you're giving up the money for 20 days. And basically, you're investing the money for 20 days by paying 10 days early.
Mhm.
$2 divided by 98, because that's what you're actually paying, is a little
Right.
over 2%. It's 2.04%. Okay.
Mhm.
That means that every 20 days, you're earning 2.04%. How many days in a year? 365.
Mhm.
So sorry. You divide that out, Kaylee, and you are actually getting a 37% discount, whether you realize it or not,
Wow.
annualized. So if someone offers you 2% 10 under today's interest rates, you would be crazy not to take that.
Right.
But companies do it because they need their money as quickly as possible, and they're
Yeah.
willing to take that bite. Sales returns and allowances. This is another contra account. Contra sales account, because you never debit sales, never debit sales. What this is all about here, customer returns something, and our policy is we take returns. So we have to reduce our sales, but we can't do it by debiting sales. We do it by debiting the contra account called sales returns and allowances. So you return something, we agree to take it back. That's a sales return. You try to return something like a toaster, and you say, I just don't like the way this thing is toasting. And you
Right.
say, and the company might say, look, we don't want it back either. How about we cut the price in half and you keep the toaster? That would be an example of an allowance, sales returns and allowance.
Got it.
Contra revenue accounts. Contra revenue accounts. Look at your formula here. This is the start of our new income statement. Companies record credit card discounts, sales discounts, and sales returns and allowances separately to allow management to monitor these transactions. If we debited sales directly and did not use these contra accounts, you would have a whole jumble in that sales number. You would have no idea how the sales number moved, how much you were losing to people returning things, how much credit card discounts are hurting you. So your formula at the start of your new balance sheet, I'm sorry, income statement, is going to be sales revenue, less credit card discounts, less sales discounts, less sales returns and allowances. All right, ready to go on?
Yeah.
Measuring and reporting receivables. When companies allow customers to purchase merchandise in an open account, the customer is promising to pay. Promising to pay. Two categories of receivables. I think we kind of know this already. Trade receivables, that's account receivable. Trade receivable and accounts receivable. These are the amounts owed to the business for credit sales of services and goods, okay? Non-trade receivables mean just that. It has nothing to do with selling to customers. It could be interest receivable, okay? Or rent receivable. Trade receivables and accounts receivable are the same thing, absolutely synonymous. And you could have long-term receivables, non-current receivables.
Okay.
Okay, now here's where we get a little tricky. Bad debts expense. We have to anticipate the fact that not everybody pays their bills. Isn't that something that you probably didn't know? Huh? Not
Mhm.
everybody pays their bills. Bad debts result from credit customers who will not pay the business the amount they owe, regardless of our efforts to get on their back and collect it. And what we must do, Kaylee, is anticipate this number as best we can. We are going to have to use the matching principle to say, we had sales this month. We had accounts receivable this month. And we know that some of those sales this month and some of that accounts receivable this month will not be paid in the future. We have to guess now what that future number is, believe it or not. We have to guess it. And there are two different methods for doing so. Okay? And you're going to be introduced in this section of the chapter now is where students really have a little bit of a tough time following. Most businesses record an estimate of the bad expense with an adjusting journal entry. So when it comes to bad debt expense, there are just two-line journal entries that we need to understand, okay? Decker's Shoes. Estimated bad debt expense for 2013 to be $4,685,000. They're just giving us the number, so we don't have to compute it. The reason for this is to demonstrate the journal entry. So let's get a good peek at that journal entry. It's the end of the month. They're looking into the future. Which of the current sales or accounts receivable are we not going to collect? Deckers thinks that they're not going to collect almost $5 million. Isn't that amazing what a big company that is?
Yeah,
That they're going to eat $5 million. Okay.
that's a lot.
So they debit, it's a lot to me. So they debit bad debt expense and they credit an account called allowance for doubtful accounts. And God bless you, Kaylee, that's another contra account. Allowance for doubtful accounts. So your first journal entry, once you know what the bad debt expense estimate is, you debit bad debt expense, you credit allowance for doubtful accounts. That's a contra receivable account. It's contra to accounts receivable. Just like accumulated depreciation is contra to the machinery. Okay? So keep that in mind if you can. So we're going to take accounts receivable less the allowance for doubtful accounts, and that's going to give us our net receivables. It's that easy. Accounts receivable less the allowance for doubtful accounts equals the net realizable value. That's the amount that businesses expect to collect. And companies, believe it or not, companies want to see some bad debt expense. They want to see that. And
Is that because they can write it off?
Well, they can write it off. In fact, that's what we're doing here when we debit bad debt expense. But the other reason, Kaylee, is anybody can sell to IBM. Anybody can sell to Microsoft. You know you're going to get paid. You have a company. You and I are competitors, right? My company and your company each do sales of about $1 million, okay? I only sell to people I know are going to pay me. So my business grew from 1 million to $2 million, okay?
Okay.
Your business was $1 million too, but then you suffered $500,000 worth of bad debt expense. But guess what? Your business grew to $10 million because you were willing to take risks that I wasn't. Yeah, you got hit with a lot of bad debt expense, but you grew your business like crazy. So you came out way ahead. So you get the idea why companies do want to see some bad debt expense. It
Yeah.
might mean they're missing big opportunities, you
Right.
know? I'm not gonna sell to Kaylee. She's new she's a new kid on the block. I don't know that much about her. Whereas a competitor said, I'll take a chance on her. And next thing you know, you become their biggest customer. Okay. Now, when we don't know who the bum is, we debit bad debt expense and we credit the allowance for doubtful accounts. Now we go into the future and we find out who's the bad debt. Now here's you use the word write-off. Here's where we're going to write it off. We have to take that bad debt off the accounts receivable, and we're going to do it using the allowance for doubtful accounts. When it's clear a specific customer's accounts receivable won't be collected, the amount should be removed from accounts receivable and charged to the allowance for doubtful accounts. So here, they're giving you the number once again. We don't have to compute anything. So Decker has to write off $6,969,000. These are people they know are not going to pay them. Let's pretend this is just one customer, $6,969,000. They didn't pay the bill in 30 days. Decker calls them up. They don't pay in 60 days. They don't pay in 90 days. You threaten to sue them. You do everything you can. And then finally, you have to throw up your hands. We're not going to get paid by these people. At that point, you can write it off. The reason we set up the allowance for doubtful accounts is to use it in the write-off. Use it in the write-off. Think of the allowance for doubtful accounts as an allowance your mother gave you, but you're only allowed to spend it on one thing, and that's accounts receivable. You set that allowance up knowing in the future your receivables are not going to be all collected. So you have to write this journal entry here. Here's a little concept that you need to understand. Assume before the write-off, Decker's accounts receivable balance was 62.4 and the allowance was 13,069. Let's see what this has, the effect this has on net receivables. So take a look here. Before the write-off, you had 62,640,000. After we remove the 6,969, we're down to 55 million that we expect to collect. The allowance was 13,069. Now we used 6,969 to reduce that. The point being, the write-off has no effect on anything. Your net receivables remain the same. It has no effect on anything. All it does is allow you to take the specific customer off the AR aging. So that's a little tricky just to get under your belt. When you're debiting the allowance account, and crediting accounts receivable, all you did was reclass two accounts receivable. You just reclassed two pieces of your net receivables. That's why you get the expense in advance, okay?
Mm-hmm.
So that's a quick look getting started on bad debt expense. 2 journal entries, just those 2 journal entries, 2 two-line journal entries. But now we have to understand how to come up with the number. How do we compute the number? And there are 2 methods. One is super simple, and the other one is a little more demanding. It makes us think a little more. One is a good method, and one is not a good method, but they both can be used. So we're going to start with the simple one, the credit sales method. There are 2 methods, the sales method and the AR method. We're going to start with the credit sales method, where we're going to just look at one thing, Kaylee. We're just going to look at this month's sales. And we're going to multiply it by a percentage. And that's the bad debt expense. It's not so hard. So Kids Clothes had credit sales of 600,000. Past experience indicates that bad debts are 1% of sales. What's the estimate of bad debt expense? Well, here it is, 600,000 times 1%. Now you're ready to write the journal entry. Pretty easy, right?
Mhm.
The sales method, no thinking in terms of once you compute the number, you've computed the bad debt expense. You've computed the debit to bad debt expense, and then you're setting up that allowance, which you will spend on AR in the future. Okay. Now, here's the other method, the absolutely proper method. Okay. For a lot of reasons. Under this method, the aging method or accounts receivable method, we're going to look at the aging of accounts receivable, meaning how old the debt is. And we're going to measure each a customer's account by breaking it down into columns. Let me show you this way. And here's an aging for Kids Clothes. So here we go. This is the aging. Well, we have a not yet due column, right? 1 to 30 days past due, 31 to 60 days past due, 61 to 90, and over 90. Our total AR balance is $235 for this guy, okay? As the debt gets older, it is less likely to be collected. That's a self-fulfilling prophecy, right? As the debt gets older, you're less likely to collect it. So based on past experience, we assign a percentage to each of these columns. So the not yet due, 3,500, we're going to multiply that by 0.01. The next column is 4%, 10%, 25, 40%, okay? We multiply it out. I said we multiply it out. There we go. We multiply it out. $35, 102, etc. So that's not too tough to come up with the 1201.
Mhm.
What makes it tough, Kaylee, is the 1201 is not the bad debt expense. It's not the bad debt expense. It is the amount we want to see as the balance in the allowance account at month end. When you're doing the aging, you're going over everything. You're reinventing the wheel every month, which is what you should do. So you're looking at your aging and you're saying we need 1201 in the allowance account. The columns are added to arrive at the total estimate of uncollectible accounts. So now they're assuming there was $50 in the account to begin with. $50 to begin with. Well, we need to have 1201 based on the aging method, and the beginning balance was 50. The difference of 1151 is your bad debt expense. Okay. So when you're doing your homework, you might have a little trouble with the two methods. The sales method's pretty easy. You
Okay.
take the sales, get a percentage, that's your bad debt expense. Here, you always have to be cognizant of the thought that you are not computing the bad debt expense. You are computing what you want in the ending balance of the allowance account. Hence, you must drive the difference between the existing balance. Make some sense, Kaylee?
Yeah.
Okay. This is a little tricky stuff.
Yeah, I was struggling on the Learn Smart with that.
Yeah, it is a little tricky. Look at your allowance account. You can make this note perhaps. If you draw yourself a T account right now, make a note on the debit side. Accounts receivable. When, in other words, anytime you debit the allowance account, the credit is automatically to accounts receivable. There's no exception to that. Anytime you debit the allowance, the credit goes to accounts receivable. Anytime you credit the allowance, the debit goes to bad debt expense. No exception to that either. And maybe that little trick will help you guys. Notice that the balance after the adjustment is equal to the estimate of 1201. All right. The aging of accounts receivable. This is just a look at the formula again. Accounts receivable times the percentages gives you the desired ending. Okay, so that's the toughest part of this chapter, I think, Kaylee, okay?
Okay.
But we got some more good stuff here.
Okay.
We're going back into the contra accounts. The
Okay.
contra accounts. On January 2nd, 2015, Coolabara's factory store credit card sales were 3,000. The credit card charged them 3%. Uh-oh. So they're not going to get $3,000, are they?
Mm-mm.
They're going to get an amount taken out equal to, I guess it'll be $9 or 1% would be 30, it'd be $90, I guess. Credit card discounts are reported as contra revenue. Contra revenue account. So get a good look at your journal entry. Get a good look at the journal entry. You see where it says debit accounts receivable? That should be cash. That really should be cash, I think.
Okay.
Credit cards are cash.
Yeah.
I don't care what the book says. Credit cards. So the only cash you're going to get is a debit to 2910, right?
Right.
We know that by paying the 2910, they no longer owe us $3,000. So the $3,000 is the actual revenue.
Right.
That's the revenue. You get credit for that sale. And the difference is 3% of $3,090. That seems pretty clear, Kaylee, at this level?
Yeah.
Okay. Sales discounts. Sales discounts. We went through credit cards, sales discounts. Now they sold $1,000 worth of sheepskin boots. I bet I bought those with credit terms of 2%, 10, net 30. Okay. So let's see. They sold it and the credit terms of 2%, 10, net 30. Sold it in the credit terms. What do you notice about the sales entry? It doesn't even consider the discount yet, okay?
Right.
Because you can't touch the discount until somebody actually takes it. You can't anticipate that.
Mm-hmm.
So now you sold it, accounts receivable, 1,000, sales revenue, 1,000. The revenue is permanent. That's our revenue, but we may not collect all of the accounts receivable. 2%, 10. So on the 14th, they got paid for the sale of the 6th. The guy paid within 10 days, right?
Right.
So here's our calculation. 1,000 times 0.02, that's a $20 discount, which means we're only going to get 980 in cash.
Right.
Debit cash for 980. Debit the contra account, the contra sales account, because you never debit sales, and the total debt is gone, $1,000.
Now,
All
the
right.
reason it's not revenue is because it was a credit, right?
It is revenue.
Uh-huh.
It is revenue. The $1,000.
But on the journal entry.
Okay, on this second entry.
Yeah.
Yeah. The reason we've already recorded the revenue.
Oh, and a separate journal entry. That's right. Okay.
Yeah.
So then, yeah, okay, yeah.
Yeah. So
Got
you
it.
debit cash. Good question. Sales discounts. What if the guy paid on the 20th instead of the 14th? What entry would you make?
Uh, it was outside of the 10 days, so they wouldn't have a discount.
Yeah, exactly right. Good. No discount. what in the real world though would a company do if someone didn't, if someone took the discount and they shouldn't have? You think you would automatically go after the person and say, hey, I'm sorry, buddy, but you owe us $20.
Probably not.
You're exactly right. Probably not. It would really depend, wouldn't it?
Yeah.
How would you like to have a customer who gives you millions of dollars of business every month, and then he always pays you on time, and then one time they're late by a day? All
Right.
you need is from one overzealous accounts receivable clerk to call up and tell the person that they're going to charge
Right.
them for the 2%. That's a good way to put yourself out of business.
Yeah.
Sales returns and allowances. Here, a customer returns boots originally purchased on account from Coolaboro. The boots originally cost Coolaboro $3,000. Okay. Prepare the Coolabora journal entry. Well, we know we're getting the boots back, so that's a sales return and allowance. So let's see what we have here. Isn't this interesting? Oops, 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 oops. Sales returns and allowances. We debit that, right? Because we never debit sales.
Right.
And we credit accounts receivable. But the boots are still good. We can put them back in our inventory. So we debit the inventory to increase it and credit cost of goods sold. Make some sense?
Yeah.
A lot in this chapter, you know.
Mm-hmm.
Cash. What's cash? We know what cash is.
Mm-hmm.
It's dollars, it's bills and coins and checks, money orders, bank drafts, T-bills, certificates of deposit, credit cards, direct deposits, wire transfers, whatever. Cash. Internal control of cash. Cash is something people love to steal. It's the one asset everybody seems to like. Internal control refers to policies and procedures designed to account for the assets and safeguard them so you have good financial records. Cash is the asset most susceptible to theft and fraud. And the one important duty you can have here, Kaylee, is to separate the duties. In other words, the person who records the cash into the system should not be the one who physically handles the money and perhaps takes it to the bank. And the person authorizing things should be a third party. And I'm going to tell this story that I tell every semester because it's based on what happened here in Santa Barbara. There was a woman who graduated from Santa Barbara High School and went to work for the police department. And she was a clerk. And over the years, she did very good work and she got promoted and her record was flawless. She was a wonderful employee for many years. And then at one point they said, look, Mary, whatever her name was, look, Mary, why don't we do this? Why don't you handle the parking tickets all yourself? You collect the money. You post the money into the system. You set the system up. You're in charge of the computer system. Well, what happened was this was too much temptation for this lady. Without the separation of the duties, she saw immediately how easy it would be to steal. And unfortunately, an otherwise good employee turned bad. Because what happened was you would get one of those very annoying parking tickets on Shoreline and you'd send in your $40. Since she was the one who collected the money, the parking money went directly to her. She would open up the mail and there's the $40. She was in charge of the computer system regarding this. So she would take that $40, go into the computer system and delete it like it never happened.
Oh.
And then she took the $40 and put it in her own account. And this went on for years and years and years until they finally caught up with her. I mean, she stole hundreds and hundreds of thousands of dollars and ended up probably still in jail. The point is, separate the duties. That would have never happened. Okay.
Yeah.
One true false question they like to put on the test is true or false. It's best to give all the important duties of a company to one trustworthy employee. No, that's a way of making them a non-trustworthy employee.
Yeah.
Yeah, that's like putting me in front of a buffet table. You know what I mean? You get your money's worth.
And saying pick two things.
Yes. All right, now we're ready for some good fun. Bank reconciliations. Bank reconciliation. Well, we just said that separating the duties is an important control of cash, right?
Mhm.
Probably an equally important one is to prepare your monthly bank reconciliation. And you want the person who does the bank reconciliation to be a different person from the one who records the money into your system. You want it to be a different person who takes it to the bank. You want a different person to open the mail. The bank reconciliation is another super crucial, important internal control. Everybody should do it themselves with their own bank statement, and most people don't, I would imagine.
Yeah, people have stopped doing it just because of the convenience of online banking.
Exactly. Yeah. Yeah. And you can you get away with it. But if somebody does steal from you, you may not know it for a while until it's too late.
Right.
But the bank reconciliation, it simply explains the difference between the cash reported on the bank statement and the cash on the company's checkbook. It provides information for journal entries. So let's see what we have here. Let's start with the bank. You're going to have two columns. This is the template, the way to do it. You take the balance per the bank statement and you add what are called deposits in transit and you subtract outstanding checks. Don't worry about bank errors. We're not going to put bank errors on the test. Believe me, the banks don't make the errors. People do when working for the company, okay? So what's a deposit in transit? That is a check that was written by one of our customers. Our customers wrote checks, and that check was recorded in our check register, but we haven't brought it over to the bank yet. So that when the bank sent us the bank statement, it wasn't there.
Mhm.
Outstanding checks are also a result of timing. Outstanding checks. These are checks we wrote that have not cleared the bank yet. Okay.
Mhm.
So on your template, you've got to look at all your deposits in transit and compare them to the bank, cross them both off, and figure out which ones are not on the bank statement. And here we have to tell us here, balance per bank statement plus deposits in transit minus outstanding checks equals what's going to be called the adjusted bank balance. This is the easy side because all it is deposits in transit minus outstanding checks. Also, no journal entries needed on this side. This is the stuff we already know. We're telling the bank here. Now, on the book side, where you start with the book, you're going to have to look at the bank statement and find things the bank is telling us we didn't know. Maybe they collected an account from somebody who owes us money. We didn't know about it. Service charges, NSF check, non-sufficient funds check, a check that bounced, no good. We did not bounce the check. A customer's check bounced. And then they got plus or minus book errors. Yes, we're more likely to make an error than the bank ever will. And we come to the correct balance. So get a look at your template there. You're going to have these two columns going. All reconciling items on the book side require an adjusting entry. And I'll give you a hint. Every adjusting entry from a bank reconciliation will debit or credit cash. And it always amazes me when students make that error. They'll say, "Oh, well, this check bounced, so I'm going to debit accounts receivable, which is the correct part, and then they credit sales." No, cash. And let's prepare a bank reconciliation, a simple one here. And they're giving us some balances, huh? Aha. So the bank statement had a balance of 9610 and the ledger 7430. So that's normal. You're never going to have the same numbers. Additional information on the next page. So let's take a peek here. Here, they started by, oh, Jesus, hold on. Here, they put the beginning balances in 9610, 7430. So let's see what else we have. We have outstanding checks totaling 2417. They're giving us the number. We have a $500 check we mailed to the bank for deposit that they had not received. So we have a deposit in transit, okay? And then here the bank actually made an error, which burns me up. I don't know why they put that on there. But let's take a look at it. And bank balance plus deposits in transit minus outstanding checks gets you there. The bank error that was made here is that money that was supposed to go to a company called Acme somehow was credited to our account, and now we're debiting it. Let's look at the stuff that we need to worry about. The bank returned an NSF check for $225. Interest, $30. Let's look at those two. NSF check. We have an NSF check for $225. That comes out as a minus. And we had interest income earned. That was $30. That was $30. And then I see two other numbers. I see 225. Check 781 for supplies cleared the bank for 268. In other words, we wrote a check for 268, and then when we entered it in our records, we entered it in as $240. And that's a mistake that can be made. So that means we have $28 less than we thought. We really spent 268, not 240. And there you go. You got the 28. So look at this. Our correct cash balance, more properly called the adjusting bank balance, is 7207, and so is the adjusted book balance. So that's a flavor of a bank reconciliation. Anything particularly troubling you see there, Kaylee?
No.
So far, so good. Got your UCLA shirt going. Hey, go Bruins, huh?
Yeah.
When are they going to get a new fight song? That's terrible. No, I'm only kidding. Now we have to write journal entries. Do we write journal entries for what is in the bank side? No. We have to write a journal entry to debit cash here and credit cash. So let's look at our journal entry. Well, we had interest revenue per the bank statement. We debit cash, we credit interest revenue. Remember the bounce check? Look where we're debiting the bounce check, 225. Does that make sense? Yeah. Because when we what's that? Go ahead, Caitlin.
Oh, I was just saying because it's yet to be received since it bounced.
Yeah, when we received the money, we
Right.
debited cash and we credited accounts receivable. Now we have to debit accounts receivable and credit the cash. In other words, we put the guy back up on the aging. And with the $28 mistake, that was for some purchase of supplies. That could have also gone to accounts payable if it was on account. And I think we have a couple of metrics. Well, we already did this already, huh? Gross profit percentage, gross profit divided by sales. And Decker's is 44.3. And they're just comparing them to Skechers and Timberland. So it's interesting. They're all about 41%. What's the difference between how do we compute gross profit? Do you remember?
I mean, well, oh,
Sales
uh,
minus,
cost of goods sold.
yeah, good. Sales minus cost of goods sold. And what is cost of goods sold? It's an expense. What does it represent?
Uh, what do you mean? What does it represent?
What I'm getting at is cost of goods sold is the amount that you paid for the
For
garments that you sold.
right.
That, that's what I'm trying to get at. And you know that.
Yeah.
Yeah. So in other words, these people, it costs them 44 cents for every dollar of sales. 44% of their money is spent just bringing in the merchandise. And that would be a key metric because it's their largest expense by far. So
Right.
Deckers is 40. So Deckers 40, Skechers has a little better, Timberland a little worse. A little better, actually. And now we come to something you're going to do in about a week. The sales turnover, the receivables turnover. This is a busy chapter, huh? We're getting toward the end, though. Okay. The receivables turnover. Companies want to know how fast they're collecting their money. The faster, the better. So if we take the net sales and divide it by the average receivables, and again, the average receivables will be the balance at the beginning plus the balance at the end of the year divided by 2. We come up with the turnover of 7.6. And Deckers has 7.6, so does Timberland, so does Skechers has the reciprocal, so 6.7, huh?
Mhm.
Well, what does that mean, that turnover? It means that we collect our average receivable amount on average 7.6 times a year. We collect the average receivable 7.6 times a year. But as you might have heard me say, if you go into a meeting with your boss, he or she, if you say to the boss, hey, Maria, we had a turnover of 7.6, she'll say, is that good? And you say, well, it means that we collected the average receivables 7.6 times. That's jargon. That's talking past somebody. The thing we want to do is turn it into days. So look at the second part of your formula. There are 365 days in 1 year. 365 days in a year. You divide that by the turnover, and as you can see here, you get 48 days. 48 days. That's 48 days it takes them to collect from customers. From the moment they ship the product until they're going to get paid, they get paid in 48 days. And whether that's good or bad, it's up to the each company. Where I worked for most of my life, that would be darn good if we could collect in 48 days. Our goal was 45, and I don't think we ever hit it. But we understand what that metric is about, Kaylee, how
Yeah.
fast you collect cash, okay?
Yeah.
And that's pretty much the end of a very busy chapter. But I think it's a little more interesting. You're
Oh
getting
yeah.
into, actual situations now.
Yeah.
The bad debt expense thing is particularly interesting to me. When I first started working in accounting back in 1972, I
Mhm.
was working for W.R. Grace, and once a week we would print out the aging. Remember that aging with the 1% in
Mhm.
30 days, 4%? And we had in those days, you had the big long green sheets, and we were a big company. I mean, W.R. Grace had a lot of, they had like a 40-page, 50-page aging, single spaced. And my job was, I said once a week, I think it was almost every day. I would sit there with a big ruler and go down each column. And as soon as someone lapsed over 120 days and they were under, say, $100, my job was to write them off.
Mm.
And that's what I did every single day for until that they moved that responsibility to some other sucker.
Mhm.
But, it was good real life type experience.
Yeah.
And I remember when I interviewed for the job I had for most of my working world with Thomas and Betts, I
Mhm.
remember Charlie Strapoli. He was a character from back in New Jersey. All the New Jersey people are characters. Anyway, he said, "Well, what do you do there?" And I say, "Well, I kind of take charge of the bad debt expense. I come up with the bad debt. I come up with the allowance and the bad debt." He says, "Oh yeah, what's the formula for doing that?" And fortunately, I was able to answer him. And then after he hired me, he said he asked the same question of another person, and they weren't able. They fumbled it. They got nervous, I guess.
Oh no.
So Charlie Strapoli, he became my boss back in New Jersey, and
Wow.
he would call up once in a while. He said, "How's it going out there?" I said, "Charlie, it's going good." I said, "We have a great group out here. We're doing all right." He says, "I don't know. I think I need to travel out there and check you out." He loved to come to Los Angeles. And I'll just tell you, I should probably trim this part of the video. He would always ask me to get him a room on a floor level because he might be drinking too much. It was easier to walk into the room.
You
And
didn't have to think about it, press any buttons or climb any stairs.
yeah, he could just walk from the pool straight into 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 the room. It didn't say much for our ethics, I don't think, but he was a funny guy. If you ever saw The Sopranos, you know Charlie. So, hey, any other questions, Kaylee? Anything we can do for you?
Not right now because I haven't started the homework or anything, but maybe in tutoring later.
Yeah,
Or
yeah, yeah,
tutoring's tomorrow, right?
yeah. Not tonight.
Okay.
In fact, I have to go into the hospital for a little brief session.
Oh
So
no.
I'll be back tomorrow. No problem for tutoring. And
Okay.
Adriana really liked meeting you. Adriana,
Oh,
she
so
didn't
sweet.
quite get the connection, but she says Bob's friend knows Anna or something
Oh,
like that. Is familiar with Anna. Oh, very interesting. All right, well, I'll let you go, pal. Okay,
all right, sounds good. Good luck with everything.
no problem. I'll
I'll
be
be
in a.
praying for you.
Yeah, thank you very much.
All right, have a good night.
Hey, bye bye.
Bye.